Ladies and gentlemen of the crypto space, we're live on a Friday, May 26th at 11:32 a.m. I've talked about for a long time now how to find comfort, to understand conditions. And to understand conditions, you need to have a bit of a macroeconomic education. You have to be able to look at some chart data. You need to be able to read through the bullshit that you hear on social media, especially mainstream media, to be able to assess where we are, to get an indication of where we're heading. And I think one of the most interesting things, I'm thinking it today, that was swept under the rug, where is it in conversation, was that the banks failed. Many banks failed. Several banks failed. Significant pieces of financial infrastructure failed. They reached the point of insolvency, which means under status quo rules and regulations, they must cease operations. And what occurred, occurred. But it wasn't a bailout like 2008, but that's irrelevant. What's pertinent is the losses were socially distributed. They were put on the Fed balance sheet vis-a-vis whatever program or acronym we want to point out. They were socialized, so it was a bailout. A bail-in, as prescribed by the FDIC post 2008, was where deposits, liabilities of the bank would be written off to balance the balance sheet. In this instance, that was not executed, even though that was the thought we've had over the last, what, decade? Many years. How many years have we talked about bail-ins? But bail-ins did not occur. A bail-out occurred, and they argue with semantics. They argue with political rhetoric that it wasn't a bailout because stockholders and bondholders were left out to dry, and the deposits were protected. There was a reason why deposits were protected. There's a reason why the bondholders and shareholders were left for their capital to be lost. That was for the political spin. But there's a reason the depositors were protected, because if the depositors were not protected, that's how you have contagion. And obviously, that's how you have a capital loss for enterprise that are dependent on those deposits for full employment. If the deposits were lost and whatever exposure enterprise had to those deposit losses were forced to liquidate their human resources, uh, it sparks obviously an increase in unemployment from a quantitative perspective, but also contagion as other enterprise fear for their capacity to service their capex requirements, be it debt obligations or human resources for that matter. So, suffice it to say, whether you want to call it a bailout or whatever the hell you want to call it, something was swept under the rug. And everyone makes like that it was nothing, albeit it was everything as compared to like 2008. It was the precursor. It was the margin, except this instance, the margins were relatively large, but the margins failed, and the margins start the cascade. Everything starts at the margins, and that was the margins, and the margins were suppressed. So I like to contemplate the significance of that. It's a thought experiment. They didn't do it. Yes, obviously there's an argument that they did it to help the people. They did it because of the contagion. They did it because the system can't handle it. We're past the point of no return where the system can handle a significant decrease in circulating supply of currency, which is interesting because if they did that and they know that they cannot allow circulating currency to significantly decrease. That's what we have, though. Let's pop it over to the main screen. Do I have it up? This is global liquidity. Let's pull up domestic liquidity. No, I don't want this. I want this. Show. Show. You're going to show? Correlation. We want to get rid of this. And Going to show me M2 or what? It's always nice to be prepared, everyone. Mm. So USM2 is significantly down, and that is catastrophic because when USM2 is down, that means debt is being repaid, and the whole system is dependent on debt to be increasing. Debt in the private sector, that creates currency units, and that means this number would be going up. It's impossible for this number to go down without something catastrophic eventually impacting the GDP of the nation, and if the GDP of the nation contracts, all hell breaks loose. And that's where we are. We're in the all hell breaks loose stage quantitatively with regard to the amount of circulating currency units. Could you imagine if there was contagion associated with banks starting to implode? You would have M2 down such a degree that it's just recursive in the effect it has on a population. Now, obviously, it's a global equation, and I briefly showed you this chart where global supply of US dollar denominated currency units is almost at historic highs from a 6-month candle perspective. And that's quite extraordinary, and that's why we see the markets behaving as they are behaving. And if you look over here on the I had the move indicator up, and I'm making a mess of my charts, but whatever. Note where the peak was October of 22, and then we fell precipitously. There's a reason why markets bottomed end of October of last year. It's because bond volatility significantly dropped, and as bond volatility significantly dropped, that allows the printing of dollars outside of the U.S. to a significant degree. Once collateral stabilizes, they're able to use it to print dollar liabilities via the eurodollar type concept. But this candle, obviously, in March, has put a volatility scare in the external U.S. dollar printing market. And right now, with between this chart and the debt ceiling, right now we're in a stage of complacency. And that's the condition that we need to assess that we're in. Complacency is nobody has an idea where the hell it's going to go, and it's going to go one direction or another really, really quickly because of all the leverage built up from options, so on and so forth. And that directionality is going to play out violently, just as we saw with NVIDIA the other day. But imagine it across large parts of entire markets, especially the smaller markets. They behave much more, they are much more volatile, and that's what will happen with the crypto markets at some point where capital flows start to significantly return to these markets. We go over here to inspect liquidity in the crypto space, specifically the primary crypto market, the Ethereum market, and we're marginally negative some over a 7-day period. Let's refresh this page to make sure that we're using up-to-date data. That sounds about right, minus 0.65%. All minus 0.54%. And we can inspect the individual chains to see where liquidity is, but I would suspect they're all draining. Marginally, minus 0.5%. It's marginal, but it's significant because that implies it's a zero-sum game. When you're in a zero-sum game or a negative-sum game, you have a concentration of capital from the majority to the few. The larger the position, the more potential for capitalization actors have. So this is a predator's market. Complacency, nobody's seeing significant capital inflow. Rabbits can't flock with the predator, so the predators are capitalizing on the rabbits, the prey. This is a time to not necessarily do anything. This is a time not to not do anything, but to continue executing normal operating procedure. Capitalization, a capacity to produce the multiples that everyone so dearly wants, is a product of both normal operating procedure and stepping out of the comfort zone on the margins. That's why I always say 1% to 10% changes everything. The 1% is, stepping out of the comfort zone as compared to normal operating procedures. So that's what we continue. It's imperative that folks stick to the script. They stick to their rule set, and everyone has their own individual rule set for how to engage with markets. This is where we are, and it's okay. And there's no reason to be frustrated. There's no reason to have anxiety, and there's no reason to gamble. And the degeneracy is absolutely rampant. I've been inspecting some of the Alt L1s. This is Pulse Chain, and the narrative surrounding it is quite unfortunate, and it creates monumental volatility. Most of the assets are nothing. They're useless. They're tokens which take 30 seconds to create. I've shown you on previous streams how to create a token in 30 seconds or less. And you could populate it with $5,000 worth of USDC and create a $5 million valuation, a $5 billion valuation if you want, which we have recently seen with the deployment of PSYOP. Now, bear in mind, that's a whole other story. But point being, it's insignificant to create artificial, fully diluted value. But as you can see here with the liquidity conditions, you see what these assets are. They're manifested of nothingness. So this is a relatively marginal, relatively insignificant chain. You have, $300 million worth of liquidity. And then the question is, unless it's paired with stable coins, the liquidity is relatively meaningless. All that matters to measure the significance of a market is the total amount of currency units that are available in that market. So in that regard, you got 10 million, wrap USDT. You got about 30 million. It was about $30 million. Pepe USDC? No, that's 1.2 mil. It's about $30 million worth of liquidity on Pulse Chain. And if you go over to here, at some point there'll be a display of it. 30 million is obviously about 5% the size of Optimism. And Optimism is insignificant with regard to systemic importance, with regard to liquidity conditions. So, if Arbitrum has over twice, 3 times the amount of liquidity as Optimism. So just put that into perspective. The opportunity of a market is the amount of dollar liabilities available in that market, because that's the whole point. That's the whole game. Your whole game is to capture more dollars. This game is scored in dollars. So if a market has less dollars, there is significantly less opportunity. And the less dollars that are available, the more opportunity there is for persons with a larger quantity, a larger proportional quantity of dollars. They're able to capitalize significantly on the smaller LP sizes. They're able to dominate and own the LP, and they drive in capital, and then they just capture all the new capital inflow that occurs because of their deployed capital. So be very careful on these ultra low liquidity networks, markets. They're very dangerous from an engagement perspective. This is an extremely dangerous environment with $30 million worth of liquidity. Food for thought. Pretty interesting, huh? Quite a different perspective. FDV means nothing. It's meaningless. I could create $5 billion worth of FDF fully diluted value in 2 minutes or less. And that is exactly what persons have done. The pairing with a stable coin is all that matters. Please be cautious of this reality of how to evaluate this the opportunity in any specific market. Let's hit some comments, help you guys out, navigate these treacherous market conditions, survive till liquidity conditions start to improve. Now, bear in mind, I expect liquidity conditions to improve. Going over to global M2, the liquidity is there. The capital is there. It's spread out across the world. So what happens as bond market volatility subsides, so this is a global chart. Sorry, this is a global chart. This is a global chart because this expresses the capacity for dollars to be printed outside of the United States. So as global liquidity conditions remain strong and bond volatility comes down, actors outside of the United States have more comfort that there is less risk to the availability of their currency units. As there's less risk, more capital is deployed. And obviously, the crypto markets are at the margins of capital deployment. The primary markets of deployment are treasury markets, bond markets, and obviously equity markets. So you really need that bond volatility to come down significantly for capital to start to deploy in a meaningful way to the marginal markets. I've said before that if we get a close of the move indicator below the TWAP on the monthly, it's very significant. And we thought we had it back in February. That was invalidated. But once we eventually get it, even if we have a ridiculous blow off top and some sort of collateral crisis event, you eventually get a break to the downside and previous support flipping resistance. And when that occurs, that's when liquidity conditions start to improve, currency printing resumes outside of the United States, and capital is deployed to the marginal markets. Paul, just noticed he was the architect. I like that picture. This is pretty cool. It's one of the few that just came out quite nice, and the architect plays very nicely with the story that I like to tell. Because when you understand the way the architect thinks, you're like, oh, that's how the system is put together. That's how the system operates. And that's quite interesting. Where's the phone call coming from? Oh, I got a phone call coming in, and it's totally in my ear right now. So that's lovely. Okay. Okay, I'm back. I'm back. Tap in the house. Dan, KG, A. Smith, Lucian, Johannes, Freedom Hacking. Hey, yo, good to see you. Listen to you, sir. Simon, I just want the house. All right, enter. I don't know what you refer, but I love banter and I love ranting. So sounds like a win-win. One curious view, good day. Tapsy, I recall when we started inspecting stablecoins on chain around December 2022 was something we sat at around 130, 140 billion. So a slow and steady drain indeed. Yes, negative sum game, less available currency units that you could acquire vis-a-vis predatory activity, or the amount of capital that's surfaced by cash flow for these enterprises that are facilitating the flow of these currency units. So there's less opportunity. And we've seen what happens when we go from 130, 140 to upper 60, 70 billion dollars worth of dollar liabilities on Ethereum mainnet. See the price depreciation, you see the volume come down, and that's where we are. So watch what happens as the cycle comes down and you see the liquidity conditions improve. And you'll realize in upcoming cycles you're going to be significantly prepared. When you start to see a bottom in the move indicator, or you see, you start to see that 1% decline in available liquidity on a network, you're like, oh, there goes the cycle. All of this is cycles. Cycles over and over again. But now you have the forward-looking indicators to tell you or to indicate to you when the cycle is about to shift directionality. Lucian, can you give your thesis on CVX? I had a bag for a long time, but looked at it again as a way to get exposure to Curve due to CRV USD. So CVX is a derivative of Curve. Now, a lot of people like the derivatives for various reasons, exposure to Frax also, and multiples exposure to CRV. Now, my thesis is that the derivative just affects circulating supply and their consumers part of a federation. So that's like external sovereigns to the U.S. sterilizing U.S. domestic bond issuance. So that's the role that they play that I see. And I'm like, okay, I understand what they're doing. That's great. And there's going to be opportunity there. It's going to attract capital allocation by persons looking to capitalize. And that's cool and all. I don't want exposure to it. And that's why I've gone with the base layer. I just want to own the fundamental protocol, the base layer, and that's all good for me. Why? Particularly because that increases simplicity. That increases the amount of consideration I have to have with regard to my own capital management. I don't need to think of what a derivative is doing, which derivative is doing better, which one is producing more revenue. I own the protocol. It generates revenue. That revenue will go up and down. And the best part is I have no capacity to change my capital allocation. So I really appreciate more and more long-term locks. I think that is one of the greatest innovations of the crypto markets thus far. A deterministic state where you cannot liquidate a position, which literally converts it to a purchase rather than a position. And to me, that changes everything. Now, that obviously is not doable for many persons. Maybe you potentially need that capital, and that's significant. So that's something to consider. It's just because it's contrary to my methodology for engaging with crypto markets doesn't mean it's not a rational way to engage with markets. Everyone in the end has to choose how they're going to engage with markets. All that matters is consistency, respecting your rules of engagement, and respecting conditions, macroeconomic conditions as well as microeconomic conditions. But as long as you understand the conditions, you can make the best decisions possible. And I think that tells us where we are in the cycle. Folks are trying to define their rules. They're trying to assess where we are in the cycle. And where we are is a great opportunity for persons to solidify, refine their rules of engagement with these extremely volatile markets and sift through what is truly significant versus what is absolutely bullshit. And a great way to assess that is to contemplate who your peers are. And who your peers are define the composition of a market. Is it a market of degenerates? Is it just pure gambling that have no capacity to understand what they're buying, why they're buying it? They just see a number and it goes down and it goes up. And personally, that type of market has a significantly increased risk profile, even though you'll have a capacity to capitalize on them meaningfully as a predator. But it's irrational. If you have peers that don't understand what they're doing, the relative behavior of the market is going to be increasingly unpredictable, irrational. So there's even for predators, there's a risk profile there. One miscalculation, and all of a sudden, the unknowing market actor, they collectively exit, liquidate, and now the predator ends up being capitalized on. Now that's very rare, but that is a consideration. Always be ahead. Understand and assess position size. The significance of the position size creates whether you're a predator or prey and where you are in the food chain. And if you consider all of these factors in any calculation of engagement, at least you're ahead of the curve. And you have a rigorous rule set for the type of engagement you're doing, whether it's capital gains on a relatively illiquid network like Pulse Chain. That's cool. On Pulse Chain, you look at this. It's actually quite interesting from a basically bottom of the barrel liquidity standpoint. You come in with like 20, 30 grand on some absolutely useless asset, you could dominate and own the LP. Pertinent to inspect liquidity versus fully diluted value. PulseX DAI, if that's the real PulseX, and that's 11 billion, that's useless. You're going to find very few opportunities, but if someone created an immutable coin, which is probably a good portion of these useless manifestations, it can present opportunity. Look, 71K fully diluted, 21K liquidity. Was that Pulse Tools? So inspect the contract. You need to inspect the contract to make sure that risk profile is assessed. But 21K, you come in with 10K and you buy half the LP, you're in an interesting position. But you got to assess who owns the majority of tokens. If they're held by the contract creator, there's a risk profile there. You don't know their alignment, but it could be the case that there is opportunity because there's millions of dollars, there's degenerate community, and if they see a 50%, 100% return on a 24-hour period, they're looking at these relatively insignificant numbers. It will affect them psychologically to deploy capital, and because you own the majority of the liquidity position, you're able to capitalize on that inflow of capital. As you can see, it's a complete psychological game. And the question is position size, the amount of capital you have to deploy, assessing the risk profile, who owns the majority of liquidity, is there a capacity for a larger actor to use you as exit liquidity, to dump on you? And that's where you are. That's exactly why you see minus 74%, minus 40%. That's why you see these disgusting numbers. 15,000%. 43K fully diluted value. Look at the liquidity. Quite extraordinary. The numbers that people will. This will drive capital in. Someone sees 15,000%, a large degenerate community, they can be like, oh my God, look at those gains. History repeats itself. It just did 15,000%. It's going to do another 15,000%. The logic and rationale is completely absent in this type of market behavior. But it is what it is, and folks, you can't expect everyone to understand the complex psychology of market activity. So we could only be so critical, and so don't be too critical. One curious view, pleasure. Lucian Tapsy, I read a post on Twitter about what would happen to convex when the emissions taper off in a few years. I couldn't digest that. Well, we'll see in a couple of years. You won't know. It's until it actually occurs, and that's why I like Curb's implementation, where it's just a massive long tail taper that just goes on until like 100 years or whatever the hell it is, like a percent or whatever it is. And there's always emissions. So what's pertinent for that kind of emission schedule is that price goes up. If price goes up, the emissions are there. So now you have a constant capacity for Curve to finance things, and that's what it is. It's the financier of the crypto space. It has established itself as that role. Quite interesting. One curious view, did you get concerned when the Ledger recovery service? No, I'm not concerned. I didn't upgrade my Ledger, and I could grab one of those lattices, the Grid Plus lattice. So I'm not concerned. There's nothing to do. Just, what I'm interested in the coming decade is when our device is going to support, instead of 24-word seed phrases, 1,024-word seed phrases. So how do we manage that, and how do we accommodate quantum computing capacity? So these are very interesting things to consider over the next decade plus maybe. My main takeaway of these streams past month is position size and how it invalidates taking a position. Very useful. If you cannot take an adequate position size, you likely have not much opportunity to capitalize. If you're putting in $1,000 into a position or an asset that has $1 billion valuation, don't expect 100x on your money. The asset going to $100 billion, it's insane. It doesn't make any sense. You're not going to get those kinds of multiples. And plus, there's going to be someone that has $100 million ownership, and they're going to get 20% of their money, and they're going to capitalize $20 million in a week or a month. And you're looking for 1,000x on the money, 100x on the money. It doesn't work. It doesn't compute. So the amount of liquidity available relative to fully diluted value indicates risk. If the fully diluted value is and it's relatively liquid, that diminishes the risk profile because most of the coins are in circulation and they're not concentrated to individual holders. It's liquid. And then that indicates upside potential. What kind of multiples can you get? If you're at $1 billion valuation, you're not getting the multiples. If you're at a $20, $30, $40, $50,000 fully diluted valuation with $30, $40,000 worth of liquidity, that's interesting. Those are interesting numbers. You could get the 100x, you could get the 1,000x. 50x times 100, okay. You get to $50 million fully diluted or $500 million fully diluted. These are the types of things that are quite reasonable or they occur. So watch the numbers, watch the position size. It makes a big difference, and it allows you to invalidate positions. The biggest thing that affects our capacity to engage with markets is looking for things that invalidate positions, because obviously there's endless things that you could buy. How do you invalidate what you can buy down to 5, 10 different things? That's hard. So you have to have a rigorous rule set for invalidating positions that are even remotely considerable. Lucian, silly question, but how the hell can I find the yield per VE curve, including bribes? It's not easy. Well, the yield comes from main page. That's CRVUSD. Classic curve. You can see the yield at the bottom. It's about 1.3%, give or take. If you go over here, maybe it's a more up-to-date number. 1%. So it's a relatively small yield. But then you go over to stake down. There's much larger yields. It's a little complicated to engage with this page if it actually loads. There you go. So, this is all money to be earned on a weekly basis. $24,000, $4,000, $3,000, $8,000. These are protocols that are paying people on a weekly basis, period. So if you have 100,000 VE curve, you could capitalize 20% on this $8,000. 20% on $8,000 is over $1,000. So if you had 100,000 curve, you could make over $1,000 a week with this position. Now, obviously, there's 4 weeks remaining. These are deployed positions, so they have a duration. They have a capacity to be diluted. And if you have more votes that exceed a reasonable proportionality, you can't even consider these small positions. I can't consider these small positions. I need positions that are larger. I need curves, size, $100,000, $150,000, and that allows me to get the exposure I need. So you could also go over to the Warden, and sometimes there's opportunities over here. But those are the 2 places of opportunity to assess rewards. This is Bunny. Bunny has a couple of opportunities available. But on Curve, let's see what loads. This is completed. 295,000 votes over here, paying about 25%. Bear in mind, when it says 25%, it's going to pay you weekly. That's 25% annualized. So you're getting 0.5% on the week. And that's how you are able to see literally exactly what you just asked for. What is the yield per VE curve, including bribes? If we showed 1% transaction fees, the vast majority of revenue is from these incentives. So, you're talking 20, 30, 40% depending on your position size. Um, Smaller, most folks are probably going to have 30, 40, 50. I mean, even 50,000 VE curve is a lot. You're talking 30 something thousand, 40 something thousand dollars have been deployed to the ecosystem. And that's a lot for most folks. And I appreciate that. And in that regard, with that kind of position size, 20, 30, 40,000, you could capitalize on these types of positions. With $30,000 deployed and you're making 30,000 votes, you'll be able to capitalize on this position. And at 35%, that's $10,000. You're making $200 and 200 something dollars a week. That's $800 a month. It's $10,000 a year. So a lot of folks see these 35% and they're like, that's a large number relative to traditional finance. But it's not a large number relative to the degeneracy, the seeking of degeneracy that's very commonplace in the crypto space. 10,000% returns. These numbers are relatively reasonable. The only reason these numbers aren't available in traditional finance is because of capital raise, dilution, and what these companies have done horribly with regard to taking advantage of their shareholders in a horrible, horrible way. So I hope this helps assess the opportunities that are available in the crypto markets, the conditions that are currently occurring in the crypto markets, as well as the greater macroeconomic landscape. And basically, this is very much a sit back and wait type situation. We have a marginally negative sum game, which means the predators are out and they are capitalizing because they can achieve the position size significantly. And we haven't even started to see curves true form with CRV-USD. Yes, the potential for CRV-USD is a significant increase in this number. This number, the 1%. If this was at 15%, oh my God, now you got a base yield of 15% paid by the printing of dollar liabilities. That's crazy. And then to top it all off, there's going to be vote rentals to maintain the liquidity of those dollar liabilities. And then you have it's recursive. These forces feed one another. And as these forces recursively are observed, they draw in additional participants seeking opportunity. And that is exactly what we've seen. Conic, Concentrator, Curvance is coming, Yearn plays the game, Staked Out plays the game. These are all federated participants that all contribute to the strength of the central actor, which is this protocol we see on the screen. Hope it all helps. 32 people in the stream, 6 likes. Click that thumbs up button. I really appreciate everyone that stops by in these draining liquidity condition times or something of that nature. Friday, May 26, 12:10 p.m. Thank you all for joining. Tell everyone to subscribe. I wish you all a wonderful weekend. Stay safe, touch some grass, have fun. It's Memorial Day weekend, I believe, the start of the summer. It's a good time of the year. I look forward to next week after party on Discord for the most rational community in the entire crypto space. I'll see you then. Peace.